the text, the slides by mana ya, topic 3 is it? Kita nak, kenapa tak ada ni? Ni topic 2. Sekejap What are we doing here? This is the, what is this? Classwork. Why topic 3 there's nothing here? Ada pun. Alright, so we have these 2 additional slides from chapter 2 and chapter 3. So I plan to go through these slides today. Hopefully it will help some of you, and although those who are already good in it, alright, you can actually revise it. Alright, so let's go into that slide where we have, can you see the slides now?
Yes.
Okay, very good.
Yes.
So this one is very quickly lah. It's just a revision, right? So, but if you need me to slow down, you let me know. Okay, so remember how many financial statements that we have?
Yes, 4.
4, right? Number 1 is your what? Soft financial position. Then you have your balance sheet, or in this case is the statement of financial position. And then you have the income statement, which is statement of your profit and loss, your SOPL. And then you have your statement of your cash flow. Can I actually make use, can I use pen? Right. So this is, can I actually using it? But I cannot write. Why is that? Okay. All right. And then, of course, the other one is what we call statement of retained earnings. Yeah. Sorry. Statement of retained earnings. So that one shows you the beginning of the retained earnings plus your profit or loss during the year, the amount of payment of dividend made during the year, and from all that. Yeah. Okay, so at the end of the class, at the end of the semester, at the end of the financial statement, you will always look into your financial statements. Yeah, you always come up with financial statements. But remember that your financial statements is not the end. Yeah, it's just the means to the end. The end is your decision making. This is in your financial statements. Why is it not moving? Right, so your balance sheet describes how the enterprise stands at a specific date. So that's why you see that balance sheet as at 31st December. But for income statement, it shows the revenue expenses for a designated period of time. So that's why your statement of profit and loss for the year ended, for the month ended. So it shows you for the period, a period, yeah. And statement of cash flow is as at also, yeah, a period of time. All right, so this is an example of financial position. All right, so at the end of the day, I want you to come up with your financial position, your balance sheet in the form that you have your assets, and then you have your liabilities and owner's equity. Yeah, I wish I could. I do not know how I can make use of this. Can I use a pen? No. What did I see? What is that listening? No, when I see what... What is that? It's a caption. How do I put this? How do I stop this? Okay. Where were we? I hope that stops. Captioning. Oh, that's it. Hello? Okay, now. All right. Okay, so some students ask me not sure about what is an asset. How do you know that the account is an asset, whether the account is a liabilities, all right? I can't give you a very direct answer, but for me, you just remember that because along the way, these are the accounts that you will see. You have your cash and then you have your receivable. So that is your asset. So whenever you see receivable means that it's an asset. whether it's a notes receivable or it could be an accounts receivable. Then you have your supplies, office equipment, all right, and building and land. So the office equipment, building and land is what we call PPE last time, yeah? And then you have the liabilities on the other side. So you have asset on the left side, and then you have liabilities and owner's equity. So total of liabilities and owner's equity, in this case, liability is 80,000, and then your owner's equity total is, how much is that? 220,000. So 220 owner's equity plus liability of 80,000, then you get a 300,000, which is the same as your total asset on the left side. Right? So again, for liabilities, whenever you see payable, means that you have to pay in the future. So it's a liability. It's a commitment to pay in the future. All right? And owner's equity is always from capital stock, or in sometimes you call it share capital. And then you also have your retained earnings. Yeah? So business entity is separate from the personal affairs of its owner. You talk about the view. All right? So these are the assets. Okay, liabilities, always your payable, is a debt that represent negative future cash flow. Negative future cash flow means that in the future you have to pay. So when you have to pay, your cash flow negative, right? But if you are going to receive, then your cash flow is a positive. Right? And owner's equity, they are made up of your capital stock and your retained earnings. Capital stock is a share capital. Itulah bila kat sini I cannot scribble. I wish I could scribble somewhere lah. Okay, so as you can see here, your asset equals to liabilities plus owner's equity. Asset you have 300,000 total, and then your liabilities 80 plus owner's equity of 220. So you have both sides 300,000. So then you say that you have an accounting equation, right? So let's analyze transaction for overnight auto service. So when talking about business, there are two types of business, right? Business that provide services and business that sell goods, all right? So if you provide services, it means that you will get your revenue upon performance of the services, all right? For services, for example, you're talking about repair shop, you're talking about repair shop, talking about give me an example of services, those tailors, yeah, you're talking about construction services. So these are that provide services. Anything else?
Barbershop,
Yeah, they provide services. Other than that, good.
Asia,
they sell services. Yeah. All right. So those are services. So when you have services, that means that you don't have inventory. You don't need to have stocks, all right, or what we call inventories, because you don't sell goods. You provide services. Yeah. But if you're talking about goods, then means that you sell goods, then you have inventory, right? Example is that you sell motor vehicle or you sell a laptop, right? So all these, so even though to a person, a motor vehicle could be an asset, right? It's an asset, a long-term asset, for example, or non-current asset, they call it now. But then to a dealer, a motor vehicle dealer, so the motor vehicle is an inventory. Yeah, because why? They sell the motor vehicle, all right? Or they sell tires, or they sell whatever lah, all right? As long as you have things that you sell, right? So that is a providing, not provide services, but you sell goods, right? So in this example, we have overnight auto service. So it means that when you do an analysis of a company performance, number one, you have to understand what is the business of the company. All right, because you have to understand, is this a company that sells services or the company that sell goods? All right, and the nature of the accounting for different type of businesses are also a bit different. So you have to understand the business first, right? So you know that, okay, auto service, what it provides, it means that it provides services for automobile, for example, yeah, repair, or maybe I don't know, upgrade of motor vehicles. So all these are services, yeah. So when you have service, that means that the company do not actually sell goods. Okay, so here we have a company that on January 20th, okay, this textbook, the slide here is an American textbook, right? So the monetary is in dollar, right? And then, of course, company also not a Malaysian company, so they don't have that Sendian Berhad at the back. But just remember that it's a company, so the more important thing is that how are we going to record the business transaction, okay? So the first one we say that January 20th, Michael McBrien started overnight auto service. Right? He and his family put in money, invested $80,000 and received 8,000 shares of stock at $10 per share. So what happened is that this Brian and his family put their money, $80,000 into the company. And upon putting invest money into the company, then the Mr. Brian, in this case Michael, all right, received 8,000 shares unit, 8,000 unit of shares of the company, and each shares carries $10 value, right? So 8,000 times by $10, then you have the 80,000 shares value. So when you have that, then you have to record. It's a business transaction, right? So you have to record. So what happened actually? Actually, you receive cash of 80,000, and at the same time, you have your shares. You create a shares, yeah. So you have cash, asset 80,000, and you also have increased a capital stock. Initially, there's no cash. Initially, there's no stock in the company. But when Michael put in their money 80,000, so that is regarded as a capital stock. All right, and that capital stock is in the form of cash, 80,000. So now you have the debit side, all right, the asset, and the credit side, the owner's equity, you have 80,000 each, so it's balanced. All right, and then you say that on January 21st, overnight purchased land from the city for 52,000 cash. So in this case, you have to understand that, okay, company overnight is the company, purchase land. All right, so when you purchase land is an asset. So you purchase land, how do you pay for the land? You pay cash 52,000. So in this case, all right, you have increase in asset in the form of land, but at the same time, you decrease your asset in the form of cash. All right, so what happened? You are going to have cash decreases by 52,000. So initially, how much you have? You have cash of 80,000. But now, because you have to pay 50,000 for the land, so now your cash only remaining 28,000. But you also have increased your asset in the form of land, and that land values 52,000. So on the asset side, even though cash changes in value, land also increases, cash decrease, land increase, but total asset is still 80,000, which is the same as the other side, owner's equity. No change, so it remains at 80,000. So far, so good? Yeah?
Yes.
Okay, then you have your January 22nd, you purchase an old garage. So old garage, okay, remember, company is an auto service company. So it means that when they buy a garage is a kind of a building. Yeah, you buy a garage for you to do the services. All right, the garage costs you 36,000, but overnight paid 6,000 down in cash. So they pay cash 6,000. So it means that from 36,000, you have paid 6,000, and the balance, you have 30,000 yet you have to pay in the future. All right, in order for you to pay that 30,000 in the future, you sign a note payable. So again, note payable is a contract between, in this case, overnight and the seller of the garage. Right, so the one, now you have note payable amounting to 30,000. Right, understand now. So now you purchase an old garage, so now you have a building. How much is the value of the building? 36,000. All right, but how do you pay? You pay by cash, so your cash reduced by 6,000. Cash reduced by 6,000, but at the same time, you increase your note payable. Previously, you don't have any note payable, but now you increase your note payable by 30,000. So if you look at the effect here, now you have cash, which is reduced from 80 to 28, now reduced by another 6,000. So now cash only 22,000, right? Land 52,000, and building is 36,000. Yeah, building is the garage that you just bought just now lah. And total on the asset side is 110,000. That's how you actually develop your asset. And how come you have initially asset with 80,000 now increased by 110,000? How do you actually finance your asset? Where do you get the money to buy those assets that value 110,000? Remember, you have owner's equity that of 80,000, and you also borrow money in the form of notes payable, 30,000. Yeah, so that's how you can have 110,000 asset, because the 110,000 is financed by, one is the owner's equity, the other one is financed by your notes payable. Because if you don't have it, all right, means that something is wrong. How could you have an asset but you do not know how the asset is being financed by, right? So that's why your asset is always similar to your equation, liability and owner's equity, because the liability and the owner's equity are the financing, all right? They are the sources of your finance of the asset you have in your business. Do you get that? Does it make sense? Okay, now you have purchase. Okay, company below, when you first started your business, normally you don't make sales immediately, right? So normally you will have to purchase investment, yeah? So in this case, you purchase tools and automotive repair equipment for 13,800 on account. So when you see the word on account, it means that you pay on credit. So it means that you're not paying anything cash now, you pay the amount later. So when it's on account, means that in this case you purchase, so it means that you're going to have to pay in the future. So on account, in other words, you create accounts payable. You have to pay in the future, right? So because of that, remember you have tools and automotive. Sorry, you have tools and equipment, which is an asset that costs you 13,800. And these 13,800 is actually financed by your accounts payable, right? So that's how you have, on this side, you have additional asset increase by 13,800. On the liability side, you also have an increase of 13,800, right? So you total up total liabilities and total owner's equity, you have 123.8. The asset size also you have 123.8. So when you do, all right, you must always make sure that this sides, all right, the debit sides and the credit sides, always the same. If it's not the same, something is wrong. So you have to check where did it went wrong, right? So you have to look for the sources. All right, and then overnight realized that the company had purchased more tools and equipment than it needed. So on January 24th, sold some of the new tools to Ace Towing. So in this case, all right, you sell your tools, you purchase, but remember, tools in this case is not your asset, it's not your inventories, it's your asset, yeah? Yeah, inventory is also your asset. So this one is your fixed asset, all right, your non-current asset. So now you sell to Ace Towing, but the cost, how much you sell? You sell 1,800, a price equal to overnight cost. So you don't make any profit. So because the selling price is the same as your cost, 1,008. So what happened now is that you know that, okay, when you sell your tools, then your tools decreases. All right, so your tools and equipment, initially it was 13,800, but now you sell 1,800. So when you sell now tools and equipment, you have 12,000 only. Balance, yeah? And then, but how are you going to pay? Now suddenly you create accounts receivable. Why? Because when you sell to Ace Towing, Ace Towing will pay you. So you're going to receive the money in the future. So when you receive, means that it's a receivable, right? So receivable is always an asset. So you're going to receive 1,800 in the future. So again, because there's decrease in tool and equipment, but also an increase in account receivable, both are assets. So the and then here we have Ace Towing pays overnight 600 as a partial settlement. So when Ace Towing, who is your accounts receivable just now, right? So initially they owe you 1,800, but now they pays you 600. So what happened is that initially Ace account receivable had 1,800, but now because they paid you 600, so cash increased by 600. But at the same time, your accounts receivable also reduced by $600. All right. So I'm not sure whether I nak pergi next page or I tak sure macam mana. Command enter pun tak. Okay. All right. So if I have to this, all right, for example, just now, if I had this, all right, let's say this one is mine. Mana nak tulis ni? Tadi pun sambung ke tak ni? Sambung. Why is it not? Dia lari. Dia tak nak kawan. Okay. I have my asset. Why is it not there? Okay. Tak mau. Kenapa ni? Okay. Tak nak pakai ni. Mengajuk. I pakai Excel sekarang. Can I use my Excel? Ish, dia dah weng. Okay, buka. Excel pun tak boleh. Okay, give me some time. Can you see my Excel now? Kenapa tak nak ni? Okay. Ya Allah. Ni dia udah masa-masa komputer weng. Kenapa dia tak nak pergi kat Excel ni? Tu ke mana dia nak pergi tu? Okay. So if you remember, alright, assuming that I have a cash account here, right, my cash. So initially, if you remember that initially I have cash. Apa ni? Right. So remember that initially I have cash of 80,000. Right. And then what happened? Initially I have share capital. Share capital, no change. Right. So why is it I put my cash here in the debit side? Right. So let's see. Okay, let's say that this is your cash. Kenapa? My computer is making me crazy. Okay. Right, so cash, so you have your, this is what you call a T account, right? Okay, so initially I have 80,000 cash. What happened? You have 80,000 and then you buy land, right? So how is this represented? So remember that when you have increase, all right, this is your debit side. Can you see this clearly? This is your debit side. All right, this is your debit. I will put it a green color. Let me see if we can have it in this color. All right, and this is your credit side. So let's put it in orange color. Right, so debit and credit. So when you purchase a land, so you're going to create another account called land. Yeah. So this land is actually your asset as well. Okay, so when you purchase land, how much is the cost of the land? you purchase land of 52,000. So when you pay cash, it means that your cash reduce. So remember the equation that cash is always asset and liabilities plus honest equity, right? So this one is your debit and this one is your credit. So whenever there's an increase, how do I put increase? Right? So when there's an increase, what do I see? Increase. Let's look for the symbol. Insert. Can I have symbol here? Okay, ada increase kat sini. Tak ada pun. Or is it not? Can we have the red colour? Mananya? Tak ada. Can you see? Increase or decrease? Warna ni je ada. Tak ada pun. Oh, okay. Command X. Satunya X saya pun wang. Command V. Right? So here if I put symbol, what if it's reduced? Alright, so asset will be credited and your liability and OSQ will be debited. Okay, this is the things that you must remember whether you like it or not. Right? Command V. Command Z. Right, debit and credit. So whenever, just now when I say that, okay, on the left side is always your debit side. So when you pay for your land, so means that your cash reduces. So you're going to debit your cash account, right? So how do you know how much balance you have? You have your balance will always be what you have the debit side, all right? In this case, your 80 will always minus your, right? So that's how you do it. Okay? Ini kenapa jadi macam ni?
It's 3 o'clock.
Okay, tak apa. Alright, so this is your balance that you have. But land, again, is an asset. So now you increase your land. That's why you have your land 52 here. So you have increased your asset in the form of land, but you decrease your asset in the form of cash by the amount 52. Right? So that's how it's reflected. So because when you have these in the T account, then you should always know how much is the balance that you have. Yeah, so in this case, I tak nak lah, jadi confused lah. Okay, what you have is the sum of, we can have this, you can always have your sum of that, so your balance will always be plus of this minus sum of what you have here, right? So that is your balance, and this one we call your balance. So at any point of time, you know how much balance that you have. For example, in the form of land, right, you still have 52, there's no debit, so you know that your balance is always 52. Your share capital, you always have your 80 here, no changes, so you know that you have a balance of share capital amounting to 80,000. All right? Okay, now. Oh, hilang pula. Okay, so far so good? Am I make you more confused? All right, so just now we stop here where you have account receivable decreased by 600. And then, all right, we have the next one is when you have overnight made a partial payment. So when you make payment to your accounts payable, you make payment by your cash. So again, your cash reduced by 6,800, and then your accounts payable also reduced by the same amount. Why accounts payable reduced? Because initially you owe them a certain amount, but now you pay them, so the amount that is due to your accounts payable is lower, it reduces, right? So I will show you later how is it going to be when you have a lot of transaction. All right, in this case, overnight recorded auto repair. So in this case, you have overnight the company recorded auto repair services, right, provided for the last week that amounting to 2,200. So remember, the company is providing services. So in this case, you are actually creating a revenue. But as an introduction, all right, the revenue is recorded as a retained earnings immediately. All right. So retained earning means that in this company don't have anything else before. So we started with retained earning of 2,200 in the form of revenue. Yeah. And then you pay your expenses. So when you pay expenses, of course, pay cash reduced by 1,400. But expenses is part of your honest equity. Yeah. So it reduces your honest equity. So how do I want to put this? Hold on, yeah. Let me check if I can have new file. I have a canvas. Hold on, yeah. Let me check if I have a canvas. Oh, I have this. It's good. So I don't have to do again. Open. Right. So here we have, let me see. Oh, okay. So this one is where you have your asset liability. So your asset. So if you look at the T account, your asset is on the debit side and liabilities is on the credit side, right? So whenever there's an increase, you're going to debit your asset account, such as all these account, cash, account receivable, land, and building. Okay. And then asset, that's how I see it. All right, you debit your asset account, either cash, it could be cash, it could be accounts receivable, it could be land. So whenever there's an increase, you debit. Whenever there's a decrease, you credit the account. But on the other side, all right, when there's an increase, you credit. When there's a decrease, you debit the account. All right. So we always refer your debit as a left side and credit is your right side. So this is how I put it. Just now remember your cash and your capital stock. So you have your, and then you purchase your land, right? So that's how it's reflected actually. Yeah. So this is actually from the example, right? Then you purchase your building. Okay. So what I want to show you now is that when you have your retain, okay. So here is it. Revenue and expenditure. How is actually revenue and expenditure? So revenue, remember, if you, revenue is income, yeah? So any revenue that you have will increase your honest equity, right? But if you have to pay for your expenses, your honest equity will be reduced, right? Remember that honest equity is a credit side. Remember your honest equity, your share capital, for example, okay. Honest equity is made up of, I think that I have it here. It's not. So let me try. I hope that I can use my pen. I have not used this for some time. What is the time now? We only have about 10 minutes to go. Okay. So remember that when you talk about your OE, I hope that I have it here. All right. So when you have your OE, honest equity, okay, there are two parts of honest equity. One is your capital stock or your share capital. The other one is your retained earnings. All right. And your retained earning is further divided into your revenue and your expenditure. Do you get this? So your revenue and your expenditure. So honest equity, remember that whenever there's an increase, you are going to credit the account. Whenever there's a decrease, you are going to debit the account. So capital stock similarly, right, is a credit account. So if you are increase, you're going to credit that, right? So increasing your capital stock will increase your honest equity. Do you get that? Increasing your honest capital stock, so means that if investor put in money into the company, right? So the honest equity, of course, you have to have your capital stock debited, credited. So in other words, your honest equity will also increase. All right, but remember that I said that your OE is made up of two items. One is capital stock, the other one is a retained earnings. You get that retained earnings? So that retained earnings divided into two. You have revenue and expenditure. So revenue is an income. So whenever you have revenue, all right, revenue will increase your kenapa lah dia jalan macam tu? I did not know how. Oh my God, sometimes it does not follow. Okay, revenue will always increase your honest equity. All right, so I wish I could put here. Why is it not following me? It goes everywhere. Not sure how to write this. See? I can't do anything. All right, revenue is a plus. So if you have revenue, that will increase your honest equity. So if you have increased honest equity, revenue should be a debit or credit?
Credit.
Credit. Rewind. Because remember, revenue increase your honest equity. Honest equity is a credit side. That's why whenever you have a revenue, it's going to be credited. I do not know how I'm going to write this. Oh my God. Okay, so this one is credit. But when you have your expenditure, of course, when you spend, it will reduce your honest equity. Whenever you have to pay for something, you have to reduce your honest equity. So when you reduce your equity, means that your expenses must be a debit side. Why? Because expenses reduce your honest equity. So that's why whenever you have expenses, the nature of the expense account is always a debit side. Whenever you have revenue, it's a credit side, because why? Revenue increase honest equity. So whenever there's a revenue, it will be credited. But whenever you have expenditure, expenses, then the account will be debited. Do you get that? All right. So in this case, it doesn't show you that it's a retained earnings here. Initially, it was a revenue, but then you have an expenses, right? Initially, the revenue was 2,200. All right, it's a plus. So you increase your honest equity 2,200. But then when you pay, then retained earning reduce. So 2,200 minus 1,004, that's how you have your retained earning of 800. Okay, all right. Sometimes, all right, you see that these are the movement, right? The movement of the accounts or the transaction that actually is taking place, all right? You see that the one in the red color is actually the movement of accounts, right? You see that you have your cash initially 80,000, then reduced, right? You pay for 52,000, then you pay again for 6,000, or here you get plus 600, means that cash in, right? You debit your account. Whenever you negative, it's a credit account, yeah? But account receivable, you have plus 1,008, and then you minus 600. At the end of the day, this is the one that you want to look at, right? All these is the one that you want to look at, okay? What else you have? All right, so your honest equity, you have capital stock, but retained earning, initially you have a revenue of 2,200, but then you pay for your expenses, so remaining retained earnings is only 800. So what should appear in your profit and loss account is only this balance at the end of the period, yeah? Some of these asset, all right, goes into your profit statement of what you call financial position, notes payable and accounts payable, but your retained earnings here, income and expenses, will be shown in your income statement or your SOPL, statement of profit and loss. Right? Okay. Right, sales revenue. If you see here, sales revenue is your income statement. Revenue is a credit, and then you minus your expenses, 1,002, so that your net income of 800. So this is 800 will be further shown later in your statement of retained earnings. But here it shows you statement of cash flow. So later, towards the end of the semester, we'll cover this topic only, statement of cash flow, and how to actually prepare a statement of cash flow using indirect method or a direct method. All right, so I won't go here now, right? But you see that, all right, how the money, because we're talking about cash flow. So you're talking about cash, the movement of your cash, right? From operating, you have operating activity, investing activity, and financing. So financing again is how the cash finance the business. So in this case, it's financed by capital stock, right? Investing means that you buy something that you can use in the future. For example, your asset, land, building, tools. All right, and then if you dispose of your sale of tools, positive because you get cash from there. Yeah. Operating activities is more of the revenue and expenses. Yeah. Okay. So this is what I said, that this appeared in your balance sheet. Asset, in this case, you have asset equals to liability plus owner's equity, which is 117,800. Okay. And then you have financial statement. We have gone through this. Right, liquidity and profitability. I think that's all. Right. So that is the end of chapter 2. All right. I have how much more? We start at 3:20, is it? Okay, let's go into very quickly into chapter 3. Where's my chapter 3? Not here. Chapter 2. Where's my chapter 3? Come on, come on. Hold on, yeah. Okay, maybe I can just go to my Canvas chapter. Oh, this is chapter 3 already. So chapter 3 is actually a revision of this. What is in chapter 2? Right? Chapter 2 are the 17 pages, right? So you see this is that income statement. So at the end of the day, it's always the three segment, these three segment, all right? Balance sheet is your SOP, income statement is your SOKI, cash flow is your inflow, outflows of your cash, under operating, investing, and financing, right? And then a cash flow shows the cash in the beginning, plus minus cash during the period, then you have cash in the end. Right, so then you have the concept of accrual, right? So this one will be next week, I think, right? And then income statement. Do you think that you need this? I can share with you if it makes sense. Okay, dah, tak ada dah. Sikit je, right? This canvas tadi sampai mana? Tak ada. I always have my canvas. Okay, I want to quickly, because I have actually shared that in your, kat mana I shared you? I pergi kat Chrome lah. Okay, let's see what is in chapter 3 quickly, yeah. Hopefully within 4 minutes that I have. Okay, you have role of accounting, all right, records. Remember that the role is actually to establish accountability for assets, yeah. So that's why it say that assets equals to liability plus owner equity. Means that for this asset, how is it being financed? You must know, okay, asset that suddenly happen that you have cash in your account, right? You cannot have cash in your bank account. You must know how is this cash? Is it from accounts payable or is it from your shareholders, all right, from share capital? And then you have to keep track of routine business activities, all right, obtain information about a particular transaction, evaluate efficiency and performance, and maintain evidence of company's business activities. So here is where we have your accounts, all right, you have the T account, the left side and the right side. The left side we call it a debit side and the credit side. So how you want to see whether debit, then you have to see whether the account is an asset, liability, or honest equity. Then you go back. What is the principle of an asset? Asset increase debit, decrease is a credit side. Yeah, so that's how you have this. Always have this equation. Very important. Yeah, whenever you have your asset, debit for increase, credit for decrease. So even though you keep on seeing the same thing, all right, but trust me, students forget. When you do your exam, you forget that this is the principle that you must follow. All right, whenever there's a transaction, you have to decide whether an asset, liability, or honest equity, whether there's an increase or there's a decrease. All right. And then it gives you, you can go through this, right? You see that how cash increases or land increases. So this one is on chapter 2 actually, yeah. Is it chapter 2 or chapter 3? I pun dah tak ingat dah. Chapter 3 kot. Alright, so then we introduce you the journal entries lah. So as long as you understand the debit and credit, so you can put that into T account, just like I did just now, or you can put that into a journal entries. Yeah, journal entry just involve 2 lines lah, debit and credit. So you should know which one is debited, which one is credited. And it's a law, not a law lah. I do not know whether it must also show the debited accounts, then only followed by the credited accounts. So what account is debited, what accounts is credited. You don't show credit and debit. You show debit and credit. So make sure that you do have that debit and credit in your journal entries. All right. Net income is actually whenever there's a retained earning. Just now I talked about capital stock and your retained earnings. Right, and then accounting period, revenue here increase your honest equity, your expenses decrease your honest equity, and then we're talking about revenue, there must be a matching principle, right? When would you record your revenue? So it depends if it's a service, when you perform the services, but when you sell goods, when the sale of goods take place, so that is the matching lah. All right, so if you have the revenue, what are the expenses incurred to generate that revenue? Expenses I mentioned is revenue is always a credit side because that increase your honest equity. Expenses is on debit side because expenses reduce your honest equity. And on top of that, under retained earning, you also have a dividends. All right, dividends is amount paid to the shareholder. All right, it's not a mandatory, but normally company pay out some of the profit to their shareholders in the form of dividends. So again, dividends reduce your honest equity. Why? Because you pay dividend, your honest equity reduces. All right, so in that case, what do you think the dividend will be, a debit or credit? Payment to honest decrease honest equity, right? So means that you are going to you are going to pay dividends. So cash will be credited because cash decrease, but you debit your dividend account because payment of dividend reduce your honest equity. Yeah, because you pay your dividend out of your retained earnings, which is your, right? So this one is an example of expenses, and then here is expenses. And how you relate that with your accounts payable. Again, expenses, if you pay now, means that cash will be reduced. But if you pay, you incur expenses on account, it means that you're going to pay the expenses in the future. So payable means that it's a liability. So you credit your accounts payable. Debit your advisor. So it means that whenever you have a transaction, there must be a debit and credit. Right? It could be debit credit of asset. It could be here in this case, debit is your expense is part of your retained honest equity. Accounts payable is your liability. So you debit and credit on the other side, or the credit side. This is good. So I want you to go through and see whether you understand how these transactions are taken place, these transactions are recorded, and how these transactions are actually shown in the this is what we call T accounts, yeah. You nampak kenapa T sebab dia macam T lah, yeah. It looks like a T, yeah. Accounts payable, all these T accounts. right? And then, all right, so what is the trial balance? So at the end of the day, remember that just now you have the balances of all accounts. So that balance will be put into what we call trial balance. All right, you put in all the balances of all your accounts depending whether the balance is a debit side or credit side. Why the trial balance is important? Because you want to make sure that before you prepare your financial statements, you have all the balances. All the balances are in is correct, lah. Yeah, because if it's not correct, it means that if your debit and credit side are not the same, then your trial balance does not balance. So something is wrong. So if your trial balance is not balanced, you know that your financial statement, because from the trial balance, you're going to prepare your balance sheet or your financial position, you're going to prepare your income statement, you're going to prepare your cash flow. So all these, right, will be based on your trial balance. So if your trial balance is not right, then, right, financial statement is also wrong, right? Accountants spend much of their time focusing on the more analytical aspect of their discipline rather than doing the data entry. Yeah, so we do not need accountant to do the data entry. All right, so normally the lower level will do the data entry. We call it as accounting or account clerk, do the data entry, but accountants more of analyzing, all right, the financial statements in order for them to make a decision. Yeah, so we want you to be an accountant, not a data or not a account clerk. Yeah, so I think that's all for today. 3:23, so I only take 3 minutes of your time. Sorry for that. If you have class at 3:30, you may leave the class now, but if you are available, all right, if you have a question to ask, you can ask me before we disperse. Where is it? Okay, question? Okay, I will give you some exercises today. Right, I want you to do that exercises before you come to class next Thursday. Today hari apa? Oh, sorry, Tuesday. Right? So I will give you some exercises. I want you to do the accounts and then come to me and send to me in your assignment. I give it as a tutorial. Yeah. But I want you to do that so that I can see whether you really understand what we have discussed during the class. Right? And before you go off, don't forget to sign in your attendance in the Google Classroom as usual. Right? So if you have anything to ask before you go off. Anything?
Madam,
Yes.
I have a bit confused. How to record the expenses, because we know the expenses when we buy something, so we reduce the cash, right? So
Yes.
how to record the cash on the asset or on the equity?
Okay. Again, cash is your asset, right?
Yes.
Okay. So when, for example, let's say you pay for advertisement. Advertisement is an expense. So you pay for your advertisement, you involve cash account. Cash increase or decrease when you pay?
Decrease.
Decrease. Debit or credit?
Credit.
Credit. All right. So you have credit cash. What is to be debited? Okay. Advertisement is an expense. What is the nature of expense? Debit or credit?
The nature of expense is revenue, right?
Expense is an expense. Mana pula revenue?
Okay, expense. When interest is debit.
Debit. Why is it debit? Why an expense is a debit in nature?
Because it decrease of asset.
No.
Decrease of cash.
No. Remember, revenue expenses, what is the top? Is part of what?
Equity.
Equity. Equity is credit, right?
Yes.
Okay, so kalau increase, you credit. But expense, does it increase or increase? Expense increase or decrease your honest equity?
Expense. Decrease.
Decrease. So kalau decrease, debit or credit?
Decrease. Debit.
Debit. Right? Because debit, because expense is a part of owner's equity. So bila owner's equity decreases, you are going to debit the account.
So we have to record on asset and on equity,
Yeah.
right?
So what would be your debit? Debit your expense, right?
Yes.
Debit your advertisement expenses, credit your cash.
Yeah. Thank you, Doctor.
Nothing. Other question? All right. Next class, I will give you one question, right? Given how to record, and then we'll see how. Yeah. Hopefully, we can come up with your financial statement. Okay. So I think that's all for today. I thank you for your attention. I hope that you have learned something today, right? Or at least you can revise, have some revision based on